Hello students, it's good to have you once again. Our topic of discussion today is tax planning and strategies. Tax planning and strategies is a very important topic for every income owner. And it's very important for you to be able to understand tax structures, how to plan your tax, and other strategies, because this is going to go a long way in determining your decisions or in affecting your decisions. And that is why you really need to know how tax are planned and how to strategize, because regardless of an income earner, whatever is going to be available for you to spend will depend on what portion of it you are going to pay as tax and other factors. For the learning objective, we'll try to identify and understand the major federal income tax features that affect all taxpayers, after which we'll try to describe other taxes that must be paid. Then we'll move further to understand what is taxable income and how taxes are determined. Thereafter, we'll learn how to choose the tax that is right for you, that's choosing the right form, because this depends on the kind of category you belong. So you need to choose the right form while filing your tax, and file and survive an audit if necessary. How are you going to go about that? Then you calculate your income taxes, and we'll try to look at the strategies or ways in which you can minimize your taxes. So as a way of introduction, like I mentioned earlier, it's very, very important for you to understand this topic, because most of the decisions that you'll be making as an income earner will depend on this tax, because they are determined by tax. Your decision, especially monetary wise, depends on your income, and your income, of course, what will be left for you to spend. Your disposable income will also be determined to much extent by this tax. So most financial decisions are affected by taxes. When you talk about finance, you talk about your spending, everything. Since taxes are compulsory, you need to pay them. So that is why you really need to understand and plan yourself very well, because your financial decisions depend on this tax, or they are affected by taxes generally. And that is why we really need to understand why and how taxes are imposed. Then what are the strategies that can be used to reduce taxes, and what role does tax play or tax planning have in personal planning? All these are still going to be discussed further as we move on. So you need to know at times the strategies that you can also adopt personally as an income earner for you to be able to reduce your tax, and how you can actually plan. The federal income tax structure is kind of progressive in nature, all right? Progressive tax indicates that as your income increases, then the portion of that or the percentage of the tax that you'll be paying also will continue to increase. So for the federal income tax structure, we're going to discuss the tax rate and tax brackets, personal exemptions, those that have some exemption, itemized and standard deductions, as well as taxable income. So all these are the structure, all right, the structure that we'll have in the tax system. So your taxable income is a function of adjusted gross income. That's the AGI, deductions, as well as exemptions. So your adjusted gross income is taxable income from all sources meaning that from all sources of income, all right, because at times individuals do have more than one source of income. So you might be working, for example, and then still maybe you're a government worker, you might still be having your own personal business and so on. So when you talk about gross income, it's income from all sources, all these sources, maybe your salary, and then maybe the profit you are making from the business and any other activities that you're engaged in that is actually earning you income. So all these put together are your sources of income. So they are all taxable. Then you minus specific adjustments. We'll talk about the adjustments. There are some adjustments that will be done. There are some monies that will be deducted, all right, and then before deducting the standard or itemized deduction. So all this is how we're going to achieve or arrive at the adjusted gross income. So these are tax rated brackets. Don't forget that we talked about the federal government tax structure the other time, and we've mentioned about the AGI, we've mentioned about the taxable income. So the next one is the tax rated bracket. There are different tax rates and different tax brackets for individuals. All right. For example, here we have 10%, 15%, 25%, until 39.6%. So these are for single filers. All right. We'll still talk about the filing system. All right. So if the taxable income is not over $9,075, for example, your tax bracket is around 10%, and the tax will be 10% of your taxable income. All right. If you're a single filer and your income is around maybe 186,350 to 405,000 and then $100 annually, then your tax, you are within the 33,000 the 33% bracket. So this will be what we charge. This is what will be charged as your tax, and at the end of the day, your tax will be around 45,000 plus 33% of excess over this. So anything over this, you pay this, and then you pay this amount, and then 33% of any excess over this. So, but there are times that those filing the tax could be married. You might be filing it as joint, right? Both couple filing the taxes as a joint or whatever, or surviving spouses. All right, some could be maybe divorce or whatever, divorcee. There are times that even married do file their taxes individually. So we're going to look at all this later on. So it's still the same. We have the tax bracket, and then we have the taxable income. All right, and then we have the column for the actual tax. So if this, if you are earning not over this amount, if you are earning anything close to this amount or exactly this amount, not over it, then you'll be paying 10% of taxable income. If your income is between 18,150 and $73,800, then you'll be paying 15%. All right, 15%. That's 10% of this, which is 1.815, and then 15% of the excess over this. Any amount over this one, you'll be paying it. Up to this amount, you'll be paying 15% of the excess. So that is how the tax rates are being considered in relation to the tax brackets. Assume that you are in the 15% tax bracket, for example. Does that mean that you pay 15% on your taxable income in taxes? Are you going to pay 15% of all the old tax? So the last dollar earned is taxed at 15%. So earlier income is taxed at a lower rate. That's the 10%, like I explained previously. It's the amount that exceeds the upper class limit and the lower class limit. Is the amount that exceeds the lower class limit that you're going to pay taxes on. So it's the last dollar that is earned that you'll be paying the 15% on, not on everything. All right, the earlier income will be taxed at a lower rate. If, for example, you are in the 25% tax bracket now, you'll not be paying the old 25% on the amount you are earning. It will be maybe 15% on the initial income, and then anything in excess of that, then you'll be paying maybe 25% or more. Marginal versus average taxes. Average tax rate is the amount of your total income taken away in taxes. Your total income, then how much of it is taken away in taxes. While the marginal rate tax is the percentage of the last dollar earned that goes to pay taxes. All right, so your tax deferred, these are just common terminologies that you need to familiarize yourself with, because you'll be coming across them in the tax filing form that we'll be seeing in some slides to come. All right, we'll be seeing them later. Tax deferred is the income on which the payment of taxes is postponed. There are some type of taxes that can be postponed. So the income on which such taxes are postponed is referred to as tax deferred. That means you're deferring it to a future date. You'll be paying the tax in future, not immediately. So this is just a historical top marginal income tax rate between 1913 and then 2014. So you can see the marginal rate here as well as the year. All right, so it's just showing the relationship between the marginal and the income tax rate for each year. So what is effective tax rate? This is the rate you pay when all income taxes are combined, right? When all income taxes are combined. For example, the federal, the state, the city, the social security taxes, all forms of taxes, when all these are combined, then we'll have what we call effective marginal tax rate. It's usually greater than the marginal tax rate on federal income taxes. Moving ahead, we'll talk about capital gain and dividend income. Capital gains and dividend income. So capital gain is basically an increase in the value of a capital asset, all right, when it is sold. You bought an asset for a particular amount, and by the time you are selling it, you are selling it at a higher price. So that is what is known as capital gain, all right? Whatever increase in value in a capital asset when it is sold is referred to as capital gain. So capital asset is an asset that you own. Of course, you cannot sell what you don't own. So initially, it must have been your own before you even talk about selling it or maybe gaining something on it. Like I mentioned before, capital gain is what you make if you sell a capital asset for a profit. If you are not selling it for a profit, if you are selling it lesser than the amount you actually bought it, then that is actually a capital loss. So on the other hand, what you lose when you sell a capital asset for a loss is what is known as capital loss. Capital gain tax is the tax you pay on your capital gain. You are selling something at a higher price now, you are making profits. You have gained something. Even on that, you still have to pay tax. So that is what is called capital gain tax. Lower tax rate on both long-term and capital gain and dividend. There are times that there are lower tax rates on both the capital gain and on dividends, all right, the return you get from the sales or investment in your bonds and shares. Long-term capital gain tax on profits from the sale of stocks and bonds, not gain from the sale of collectible, not the gain from your personal collectible. They are just gain on tax profit from the sale of bonds and stocks. All right. So capital gains are not claimed or taxed until the asset is sold. As long as you are still withholding the asset, you are not going to pay capital gain tax. So if you still have it with you, then it's still your asset. There is no need to pay until you sell it and get profit from it. That is when you'll be paying the capital gain tax. Long-term capital gains on homes. There are times that we do invest in properties, all right? We buy homes. Capital gains taxes for most homeowners on sale of their homes is also being paid. By the time you sell, of course, homes are assets. So when you sell them, you gain most likely, and at the end of the day, you are expected to pay taxes on that. So exemption up to $500,000 for couples filing jointly, that's $250. Filing single on on sale of a principal residence, and this implies that you must have occupied that particular asset, that particular house, for 2 to 5 years prior to sale. Of course, this case is particular to the United States. If you are in another country, you may need to check your government tax filing system and so on. So For the US, that for the United States, there's an exemption of up to $500 that are filing. They're filing their taxes jointly. That's together as a couple. There are times that they file individually, depending on their sources of income and perhaps some other family considerations. So the property or the house must have been occupied. You must have lived there. Maybe if not you personally, people must have lived there for 2 to 5 years prior to the period that you want to sell the property. Filing status. Filing status is the key status that determine your tax liability. All right. I mentioned earlier that there are times that some couples do file their taxes jointly or individually at times, depend on whatever factors they considered. So people do file statuses, they do file taxes using different status. At times, it could be single, all right, maybe not married yet, but working and earning income. So you still have to you still have to file your tax, all right, as a single. Some are married, filing jointly, and surviving spouses. Some are married, filing separately, all right. Some are head of household. Each filing status has its own tax rates, which applies to various tax brackets. We've talked about tax bracket the other time, where we're talking about the percentage, 10%, 15%, 25%, and so on. So these are the tax brackets. For what we have here, single, married, married filing separately, and head of household too. These are these are the forms of filing status. All right, you can use any, or you can follow any of the categories here. All right, when you're filing your taxes. Cost of living increases in tax bracket, exemptions and deductions. So these are we've talked about some of these terminologies previously, and I said I'm still going to come across them again. So tax bracket change annually to reflect changes in the cost of living, depending on maybe if there is inflation or something like that. So tax bracket depends on government decision. All right, the government normally decide okay, what percentage should be in whatever brackets. Standard deduction and personal exemptions are increased to reflect inflation. When there is inflation in the economy, then there at times there are some deductions that are being made, and at times that some people are being exempted from paying taxes due to this inflation. There are times that it could be as a result of maybe unexpected circumstances. All right, for example, when COVID came, all right, COVID-19, there was actually a lockdown, all right, almost globally, and then people were not able to work, people were not able to go to work, and so some governments actually used their initiative to, exempt some people from paying taxes and so on. So the bracket creep is that increase caused by inflation increasing wages. Paying your income taxes. How do you pay your income taxes? Could be pay as you go, especially if you're a government worker or a salary earner. Your employer is expected to keep a certain percentage of your income. You're not expected to be given the whole income. Some of it is being withheld, all right, from your wages. You're not given everything. So it will be withheld and then remitted to the Internal Revenue Service as tax. So there are times that quarterly estimated taxes are sent to the Internal Revenue Service, that's the IRS. There are times that payments payments will be made with tax return. And withholdings from stock, dividends, retirement fund, and prize winning are also, at times exemptions from your taxes. All right, withholding from your stock dividend, when you make dividend from your stock. All right, retirement fund as well. Retirement fund are usually exempted. They are usually being exempted, or maybe prize winnings. Prize winnings too are exempted from taxes. All right, they are deducted before your income is being taxed. You have some control over how much is deducted from the taxes, all right, from your wages. There are times that you may need to discuss, or there are times that you may use other strategies that we'll still talk about to reduce that proportion of your income that will be taxed. Withholdings are determined by income level and information on the W-4 form. There are different kinds of form. The particular case we are taking is that of the United States, so it could be different from for some other countries. So please take note of that. All this W4 or W, what you will still come across some other kind of forms too. Withholdings are determined by income level and information on the W4 form. W4 form usually filed out or filled out with new employer. All right, when you are being employed by a new employer, then you're expected to fill that form. Your marital status and the number of exemptions, the number of exemptions claimed, and so on and so forth are usually required for this W4 form. Other taxes include the income-based taxes, right? Other forms of taxes. The income-based taxes is what we've been talking about all the while. That is the tax that depends on your income, your sources of income. All right. For example, the Social Security of the FICA or the FICA, and then the state and local income taxes. Non-income-based taxes include excise taxes, property taxes, the taxes you pay on your properties, then the gift and estate taxes. These are just few or some of the other kind of taxes apart from your income-based taxes. There are some that are non-income based, right? So whether you are earning or not, as long as you are involved, or as long as you have them. For example, the property tax, as long as you have the property, you have to pay tax on it, whether it's yielding income or not. Now we are moving to calculating your taxes. Must you file a tax return? Yes. As an income earner, you have to file a tax return. It depends on your income, your filing status, whether you're married, whether you're single, whether you're divorced, and so on. It also depends on your age, or whether you can claim or be claimed as dependent. All right. Some people may be earning some income, but they might still they might be dependent. All right. Maybe they are still underage, maybe less than 18 years old, just trying to make ends meet by doing some menial job to earn something. So they may be exempted. Dependent means that the person you support financially, you are depending on another person for a living. So you are supporting somebody financially, then that person is dependent on you. Calculate taxes anyway to get any refund that is due to you. You also need to file, you also need to fill in some necessary information if you want some exemptions to be made for you before your taxes are being calculated, because if you don't do that, then you might end up paying more as tax, right? So you can, if you have dependents, if you have, there are some other factors as well, like we said, maybe your income as well as your filing status, even your age can go a long way in determining the amount you'll be paying as tax. All right, so all this need to be imputed, all this need to be provided in detail so that you will be paying the right amount. You will not be paying excess as tax. Determining the gross or total income. Like I mentioned earlier, your gross income is an addition of all your sources of income, not only one. If you have more than one, then you have to add. If it's just one, then fine, that's your only source of income. But if you have more than one source of income, then your gross or total income will be an addition of all this income from the different sources. There are some of all taxable income from all sources. Active income is the income from the wages or a business. You are earning a salary, then that is active. Then, or you are making profits from a particular business, it's also an active income. Your portfolio or investment income is that on which you have invested. All right, that's part of income that you get on your investment, while the passive ones are the activities in which the taxpayer does not actively participate, do not participate in them. Now we are moving to calculating the AGI, that's the adjusted gross income. Don't forget that I said it's just an average, the total of all your income, your taxable income. So gross income less allowable adjustment. There are some adjustments that are allowable, all right? There are some deductions that are allowed to be made before your taxes are being determined. For example, your retirement contribution. You are contributing towards your retirement. So that should not be, all this should be deducted from your income before it is being taxed. Otherwise, it will be too high. All right, your student loan interest paid, you are still paying your student loan. So your moving expenses, all these are categories of adjustment that need to be deducted from your income, all right, before it's being taxed. Reimbursed educator expenses, your health savings account contributions, all these are forms of deductions. They are deductions that should be made from your gross income. They are allowable adjustments that should be deducted from your gross income. When you're subtracting deductions, you need to take greater deduction between standard and itemized deduction. All right, for itemized deductions, there are list of deductible expenses, medical expenses, tax expenses, mortgage interest payments, all this. While the standard deduction is the government's best estimate of what the average person would deduct if itemizing. So for the standard deduction, it's the government that determines it. It is the government's best estimate of what the average person will deduct if itemizing. So this is an example, a typical example of a standard deduction amount. In 2014, you can see for single, it's to $6,200. For married filing jointly or surviving spouse, if the person is a widow, all right, $12,000, widow or widower, $12,400. Head of household, $9,100, and married filing jointly, $6,200. So these are just an example. Claiming your exemption. How do you claim exemption? Exemption are deductions for which a person is supported by the income on the tax return. Deduction for each person, all right, that is supported by the income on the tax return, the tax return. An exemption includes yourself, your spouse, or your dependents. Dependent must qualify as a child, or dependent should be able to prove it without any reasonable doubt that that person depends on you or is your dependent. So you are claiming your exemption for yourself, for your spouse, or your dependent. So all these are just exemption are just deduction for each of the person. For example, maybe their health insurance. Now you want to deduct that is expected to be deducted anyways from your income before it's being taxed. So all these adjustments will be made before the tax is being calculated on your income. So step 5 now is calculating your taxable income. We've taken about 4 steps earlier, all right? And then the next step is calculating your taxable income. By the time all those adjustments have been taken care of, we've talked about the filing status, we've talked about the brackets, we've talked about the AGI and so on. And then now we are moving on to calculating your taxable income. And from that, you now calculate your base income tax. What is taxable income? What is referred to as taxable income? So for taxable income, you are going to subtract deductions and exemptions from the AGI for you to arrive at your taxable income. Like I mentioned, your source or sources of income is not going to be taxed totally like that. There are some adjustments that need to be made, all right? Some deductions need to be made, some exemptions need to be made. So by the time you adjust for all these or for these two, then you have what is known as taxable income. That's the income that is left, that can be taxed, all right? By the time those are deducted, then you have something that can be taxed, and that is referred to as your taxable income. Next is the base income tax. This is an intersection of filing status and taxable income in the federal income tax table. There is a form, all right? There is a table, or in the form of or we call it a form, that is the federal income tax table, where you can see the intersection of your filing status and the taxable income. So it's like going to look at the rows and column, and you look at the intersection of the two, where you have the intersection. So the alternative minimum tax, that's the AMT, ensures that wealthy pay enough taxes. All right, there are some alternative minimum taxes, especially that are expected to be paid by the wealthy people in the society. And this is just to ensure that they pay enough taxes because they are earning more. So these are the steps in calculating your taxes, all right? Determining the gross or the total income, the total taxable income. Then you calculate the adjusted gross income, that's the AGI, before you subtract, all right? Before you subtract the deductibles, and then you calculate your exemptions, all right? Then you move on to the next two steps here. So these are the steps, the basic steps in which you're using calculating your taxes. Determining your taxes. I mentioned earlier that we're going to look at both the row and column. That is, excuse me. Assuming you are married, that's your filing status, all right? You are married, filing jointly with taxable income of this. This is your taxable income. Your taxes are 6401. So you're going to look at this, for example, if line 43, if line 43 taxable income is at least this amount, all right? At least this amount, for example, 48,600, and then you are maybe you are single, for example, there is a particular amount you want to pay. If you are married and filing jointly, then you look at the column. If you are married and filing separately. So for this particular or typical example now, line 43, the taxable income is 48,000, all right, 48,600 here, and then you are filing as a marriage. Okay, you are filing jointly, maybe you and your partner are filing jointly, then your tax is 601. It's just like looking at, the method we're using, looking at a four-figure table, right? You look at the column and then you look at the row. The intersection is where you have the amount you'll be paying as tax. So for this particular couple, their tax is at least 48,600, and they are married, filing their tax jointly, so they will be paying 6,401 as tax. So this is just a typical example of how you can use your tax table to determine your tax. The next step is to subtract your credit and determine your taxes due. Tax credits reduce your actual taxes paid. All right, you're going to reduce it because it will be deducted. Tax credits phase out as your AGI increases. We've discussed about the AGI. Then your child credit, education credit, child and dependent care credit, earned income credit, healthcare premium credit, adoption credit are all forms of credit that will determine your tax due. They are all what will be deducted. All right. And these tax credits will phase out as your AGI increases. As your AGI increases, they fizzle out. They phase out. Other filing considerations. You can choose the right form between 1040EZ, 1040A, or 1040. There are different forms. Okay, like I mentioned earlier, this particular case is that of the US, depending on the dependent income and itemizing. So all these forms are different. They indicate different things, right? So, and they depend on the dependents, maybe the number of dependents that the person has, all right, the taxpayer has, the income, as well as the itemizing. So these are the checklist. You might be able to use the form 10040EZ if, for example, your filing status is either single or married filing jointly. All right. If you are married and you are filing jointly, it's more or less like you are two in one, like filing it as a single person. So you don't itemize your deductions. Your taxable income is below 100,000 annually. If you are under age 65, your taxable interest income is less than $1,500. You have no dependents. You aren't making deductible contributions to any IRA or deduction for student loan interest, and you don't have alimony, taxable pension benefits or social security benefits to report. So if you are, if you have all these, or if you fall in all these category, then you will be using this particular 1040EZ form, all right, to file your tax. The next form is the 1040A. You might be able to file, to use this particular form if, for example, you don't itemize deductions. Your taxable income is below 100,000, just like the E04, the previous form. You have capital gain distributions, but no other capital gains or losses. Your only tax credits are for child, education and income, child independence, and so on. Your only deductions are for IRA contributions or student loan, and your income was limited to wages, salaries, tips, and the like. So if you also fall under all these category, then you can use the 1040 form. So common schedules used with these forms: Schedule A to E, we have Schedule A to E here. Schedule A is the itemized deductions. Schedule E, ICE, end income interest. Schedule C, profit or loss from business. Schedule H, household employment taxes, and so on, until Schedule SE, which is the self-employment tax. So these are just the different schedules that are used with the form that we mentioned from 1040. All right, we'll talk about, I think, 1040A and then 104, I think 40EZ or something like that. So these are just the different forms. Other filing considerations. What are the other things that you need to consider while filing your taxes? You can file by email or electronic by mail or electronic filing, which is very easy. All right, some of the benefits includes faster refund. You get your refund on time. It's you get more accurate refund because everything is electronically computed. Quick electronic confirmation. Delete the paperwork. There's nothing to mail or the federal state e-filing. So these are some of the benefits of filing your taxes electronically. Filing late and amended returns. Actually, filing late is not encouraged because there are times that you may even be penalized for doing such. So file late form, you have the form 486A, that's to request an extension if you are unable to file. So it's not about just sitting at home and not paying the taxes. You need to fill a form for extension if you know that you will not be able to to file your taxes. Amended return form is also available. That's 1040X, which should be filed within 3 years of the original tax date. Then you amend the state and local form as well are available, okay, for application if you think that you need extension or amended returns. Being audited. Audit is an examination of tax return by the Internal Revenue Service. All right, they examine your tax so far, or maybe since when you've been, or the most recent one. It could be either recent one or over time. All right, so they are randomly selected. Higher odds if you have been audited in the past. They are randomly selected for examination by the Internal Revenue Service because there are times that they do all this. They might check or maybe corporate organizations or even businesses at times for companies. You want to see if their employees are actually paying taxes or if they are paying their corporate taxes as well. So you're asked to send additional information in email or IRS face-to-face interview when need be during the auditing. The re-examine areas in question, you get all data and records, the appeal unit, the appeal audit outcome, if necessary, is being provided. So this is just a few things to note about being audited, right? Helping in preparing taxes. You can handle your taxes by yourself, just by going to the revenue generating body in your country or your state. So you use IRS publication, that's the Internal Revenue Service publications, IRS outline, self-help publications to know the category, the status you belong, the bracket you belong, and then, and so on. And there are also computer programs too that are meant for this tax preparation. There are some computer programs that can assist you. Or at most, you can also hire a tax specialist who is going to handle this for you. So rather than you going to the office yourself or, going through the stress of reading the publications or inputting data into computer programs to determine and pay your taxes and so on, you can just hire a tax specialist who will do all this for you. Model taxpayers, the tailors file in the federal tax return. This is a particular case that you can refer to the textbook. It's about Chalk and Taylor, and you can refer to the book that has been provided. I've attached it. I think you can check the first week to read about the case. All right, it's just a case and how the form, the taxes are being filed, the form they obtained, and so on. So this is the federal income tax for the tailors. That's the particular case that I mentioned just now. I'm so sorry that this is quite the font is quite small, so I may not be able to read or explain. And usually that's why I'm referring you to the book now. So where you see that they are using the form 40, which we've talked about in filing their taxes. You see the different categories here and so on. All right, using the form 1040. Please take note of that because there are different kinds of form. I think there is also the 1040A and 1040EZ, if I'm not mistaken. So there's the schedule form for the tailors 2013 federal income tax return. Then the strategies to lower your taxes. What are the strategies that you can adopt to pay lower taxes? All right, so it's not just about paying tax. You need to also strategize. One of them is to maximize your deductions. We've talked about some deductions and that can be exempted, or that can be made from your income before we get the taxable income. So we try as much as possible to maximize these deductions. I think we're still going to talk about method of maximizing your deductions. You look at the capital gain and the dividend income. We've talked about both earlier. Your capital gain, that's from the profit you gain from the sale of assets. All right, so you're selling an asset at a higher price than the price you bought it. So that's the capital gain, and the dividend income is that which you get from your investment on your maybe shares and bonds and like. Shift income to family member in lower bracket. That's another method, right? Part of your income can be shifted to the members of your family who are in the lower tax bracket, so that you will not be paying much tax. You can receive the tax exempt income, right? Or defer taxes to the future. If you think currently you need more money and you'll not be able to pay as much tax as is expected of you, you can also, defer the taxes to the future. You can obtain the form for tax deferment. So these are the strategies to lower your taxes. To maximize deductions, you can reduce the taxable income to the minimum. All right. So meaning that you use tax deferred retirement program. Like I mentioned, your retirement program may not be taxed. You will not be paying tax on what you are saving for retirement. Use your home as a tax shelter, or you shift and bunch the deductions. Look to capital gain and dividend income. We've talked about capital gain as well as dividend income. We've explained what they are. Long-term capital gain rate is lower than ordinary income tax rate, right? No tax for those in the 10 to 15% tax bracket. No capital gain tax for those that are in that bracket. So the more reason why you can also explore maybe shifting some of your income to trusted family members who are within the low bracket, because they will not be paying taxes on that income. 15% tax for those in the 25 to 35% tax bracket, 20% tax for those in the 36.9, and so on. You don't have to claim capital gain until the asset is sold. All right, until you sell the asset, the government will not be taxing your needs. So until you declare the sale of that asset and you declare your profits from that, that is when you will be taxed. Qualified dividend from corporations are taxed at same low rate as long-term capital gains. Shift income to family members. This can be complex and involve lawyers and establishment of trusts. You have to be careful when dealing with it. Just because you don't want to pay your tax, you have to be careful in shifting your income to family members. Especially you need to think about the issue of trust. You have to trust, and then maybe you may need to hire legal practitioners for them to, get everything documented so that you don't forget at the end of the day. Simpler way is to make gifts. Recipients do not pay taxes as on gift either. Okay, those that will be receiving the gift will not be paying taxes. So you can maybe also make gifts. Allowed to give $14,000 tax-free per year to as many recipients as the donor wishes. You give some of your estate while you are still alive. That is another form. Otherwise, you have to continue paying taxes on them. All right. So if you are still alive and you think you have many properties and you are paying much, another way to reduce that or to reduce the tax is to give some of them out. Receiving tax exempt income, tax exempt, you want an exemption. So interest from state and local government debt such as bond is tax exempt. All right, when you are buying bonds from the government, whether the local government or the state government, they are tax exempt. The higher your marginal tax bracket, the more beneficial the tax-free income is. So the more you invest on this kind of bonding, the more you will be having a tax-free income. Calculate the equivalent taxable use to determine which is better investment. So the equivalent taxable use is calculated using this formula: the tax-free yield on the municipal bond divided by 1 minus the investor's marginal tax bracket. Don't forget that we've talked about the marginal tax bracket earlier. So this is how you determine your equivalent taxable yield. So by the time you determine this, you'll be able to know which of the investments is better. You defer taxes to the future at times if you think you need money presently and you don't want to pay much of it as tax. Tax deferred retirement plans allow you to defer tax payments to the future. Both IRAs allow taxes to be paid on contributions and never again. You just need to obtain the form. Capital gain taxes are postponed until you sell the assets. This has been mentioned earlier. Until you sell the assets and you declare the sales of the assets, your capital gains are not, your capital gain taxes are not being charged. They are usually postponed. So summarily, we've talked about taxable income as a function of the AGI, deduction, and exemptions. So we mentioned the fact that you are not going to be taxed on the gross or the total income that you are earning. No, some adjustments need to be made here and there, some deductions need to be made, and some exemptions too. So apart from the federal income tax, there are social security and Medicare taxes, state and local taxes, excise, sales, property, and goods. So these are non-income form of taxes. To calculate taxes, you determine the total income first, adjusted gross income, taxable income, then the tax that you actually owe. Then we move further to discuss the importance of filing a return. All right, when you file, you use the right form. When you're filing for return, you use the right form and the information needed for the return. So even the information needed is what should actually drive the kind of form that you're going to obtain or that you're going to fill to claim the file return. Obtain the help you need for filing return from the Internal Revenue Service, self-help tax books and computer program, as well as tax specialists. And lastly, we discussed about the 5 general strategies that can be used to reduce your tax to the barest minimum. On this note, we've come to the end of our class for today. Hopefully, we'll be meeting again next week, or we'll be discussing about the next topic, inshallah. Before then, please do take care of yourself and stay safe. Don't forget to refer to the portal for the ebook so that you can refer to that case of tailors, and other resources will also be posted there too. Take care. Bye. See you later.